Hello, this is John Smallwood, Certified Financial Planner, Senior Wealth Advisor at Smallwood Wealth Management, author of the 5 Ways Your Wealth is Under Attack book, and a couple other papers. What I want to do today is I want to delve into something that is probably one of the greatest financial pressures on our wealth. It's called taxes, okay? We've heard about taxes. We've heard how to avoid taxes, how to defer taxes, how to postpone taxes. And there's a lot of different things that go on during the course of your financial career from the standpoint of accumulating wealth, deferring wealth, et cetera, et cetera. And there's a lot of misconceptions. And what I want to kind of achieve today in this presentation is an understanding of the historical tax code, what that impact is, and how it might play into your financial strategy. 99% of the financial advice that I see out there is defer, defer, defer. Defer into your 401k, defer into your IRA, defer into a deferred comp. But the sole purpose of deferral, if you think about it, is to take money from a high tax bracket and defer it to a lower tax bracket. And I'm not sure that that is always the case, okay? So if you have 100% of your eggs in one basket, let's call it the deferral basket, and taxes are at the current level that they are, and then they go up in the future, is that really going to work in your financial strategy? So what I thought would really be helpful here is to get clear on the current tax code, okay? And what we're going to be talking about right now are the marginal brackets, okay? And we're going to just pick on one column on here, make this really simple. And we're going to talk about the married filing joint tax return, which most of us are in. Some of us are in the head of household. Some of them are in the single, but we're going to focus solely on the married filing joint side of this, okay? And what we see is collectively right now, there are 7 tax brackets, okay? And those are considered marginal brackets. So if you're earning over your adjusted gross income after deductions is over $450,000, all of those last dollars are being taxed at the 39.6%. As you're aware of, there's been some other taxes that have come in over the last year, such as the Medicare tax, which is another 3.8% on top of that number. So this was a big jump. We went from a 35% bracket up to a 39.6% bracket, plus the state that you live in, okay? So when we talk about tax brackets, we talk about there's an effective tax bracket and there's a marginal tax bracket. The effective tax bracket is in essence, where your income falls in this and the average amount of tax that you've paid across all of those tax brackets. And I'll show a slide later that'll kind of make it a little clearer and you'll see it. But the marginal bracket is the last dollars. That's where your last dollars are being taxed. So bonus income, interest income, dividend income, et cetera, et cetera, et cetera, is being taxed in the marginal bracket. The last dollars are where you're being taxed. A deduction, such as a mortgage interest deduction or a 401k deduction, occurs in the marginal tax bracket. That's where the bracket occurs. That's where the deduction occurs, okay? So what we see is, this is kind of a chart that, focus on the red line for a second. The red line is the income tax bracket. We're doing historical data from 1946 going forward all the way to 2012, okay? The blue line or the purple line, this line, is what we're calling payroll taxes. And what you're going to see here in payroll taxes are Social Security, FICA, Medicare, those type of payroll, those taxes that are deducted from your payroll, self-employment tax, okay? This number has been a constantly increasing number all the way through. And last year with that 3.8% Medicare tax, that tax went up dramatically again. So what we're seeing is that the income tax, with the historical rates being very high, and we're going to get into that, that has been a constant as far as the percentage, the 40% of collections come from income tax. Through all the area, what's been declining has been the green line, which is your corporate income tax. So corporations have been paying less and less and less over time, But how does this affect us? Payroll taxes affect us. Income tax affects our financial strategy. Everything that we get in our lives is going to be taxed, okay? Taxes first showed up in I think it was 1861, where President Lincoln put in the first income tax to kind of refund the war, kind of pay for some of the war. It was a 3% tax over $800. And it kind of languished for a while, and it was there. And not until 1913, when we had the 16th Amendment, this is where things all changed. The tax law changed, and basically the 16th Amendment gave Congress the power to tax all forms of income. And from that point forward is where we really need to understand what has happened, okay? And the idea is that since this point, what we see here is we've done two things. We've put in here the marginal bracket represented in the red line. The blue line is the lowest tax bracket. So going back to that earlier chart where we had that, that first 10% tax bracket, that would be the lowest bracket that's being done. So 1913, the tax comes out, the 16th Amendment, it's a 7% tax on income at that point in time. And if you looked at some of the newspaper articles and you went back in time, it was really a temporary tax to refund war debt again. And a lot of the articles basically point to the fact that once the war debt was repaid, there would be no more taxes. That really did not happen, right? Let's really focus on this. So you're here, you're at a 7% tax bracket. By 1919, 1918, you're at almost 78%. We get into 1927, we come down into a 25%, and then we go roaring up to a point here where 1946, we're in a 94% tax bracket. 94. So the last dollars, that marginal bracket, is being taxed at that level. And that was a period of about, if you look at this, it's almost 20, 25 years where we were in this 90 plus tax bracket. So Ronald Reagan wrote in his book, 1954, I think he made $1 million. And he didn't have any tax planning in those years. And he ended up paying close to I think he said he paid close to $900,000 of tax in that year. Seems almost unfathomable, right? But that was the reality of what was going on. And then what we saw is the bracket come down to 70%, then down into the 50%, and then the Reagan era cuts down into the 28% bracket, and then we've been slowly creeping up, okay? Now, how does this impact us? If we think about this, the tax, all of this income tax, for all the period up to about here, the income tax rate and the capital gain rates were identical. They were pegged. If it was 94% ordinary income, capital gain was being taxed at the same rate, okay? So the idea here is that if I'm deferring in a 25% tax bracket to the future with the intent or the hope of being in a lower tax bracket, and I'm successful and I accumulate capital, if I defer from here at 25% to here, let's just pick this 1930 to 1950, a 20-year time frame, I deferred at 25%, 1950, I'm in a 90+% tax bracket. Was that a good idea? Did that make a lot of sense? If all of my eggs were in that one basket, that was a terrible idea. Now, conversely, if I was here in a 90% tax bracket and I was deferring to this, to this, to this, that was a good idea. Now, the marginal top bracket, this red line, the history of that, the average of that is almost over 50, 55, 56%. And it's heading, that average is being pushed up now by the 39.6% bracket that we now have. But what I want you to focus on for a second is that what we're seeing is the financial pressure. Okay, the pressure is on When I earn dividends, I earn interest, I earn capital gains, I earn money. The tax is putting pressure on our wealth. It's leaking out of our financial strategies, okay? And that the government has the ability to basically manipulate a few different categories here, okay? So the tax rate, which is what we're talking about here, is one of those. The other thing is the amount of deductions that we're able to take advantage on our tax return, which is called itemized deductions. When you typically go after you get to the first 2 pages of your tax return, there's a page that says itemized deductions. On that page, you have medical, you have state and local taxes, real estate taxes, mortgage interest deduction, you have your charitable contributions, and those are deductions that are going to lower the amount of taxable income that you have available to you. And over time, what we've seen is that through the 80s and the 90s, the amount of deductions that are available keep going down, and they're phased out. Okay, so that the idea is that I'm manipulating the amount of deductions, I'm manipulating the tax bracket as the government, okay, as Congress looking at taxes, but also there's that number before that we saw, the 450,000, the threshold. So there's 3 tools that we're focusing on, okay? And what we did here is we created a chart where we were looking back. For example, in 1913, they had 7 brackets. The first bracket ranged from 1%. The top bracket was 7%, as I said earlier, okay? The top income bracket was over $500,000. I didn't notice the typo till right now. But the 7th bracket, 7%, everything over $500,000, if we adjusted it for inflation, that would be close to $12 million of income. So everything over the $12 million number in today's dollars would have been taxed at 7%. I think we would all really appreciate that, right? But what I want you to look at is the bracket, the top number in 1917 was gone from 7% to 67%, but the top number went from 500,000 to 2 million, which is the equivalent of $36 million, okay? And so what we're looking at is this number is constantly moving throughout the tax time, 200, 400,000. So what's interesting is if I look here in 1982, this is when Reagan starts coming in and we're lowering the bracket from 70% down to 50%. What's interesting is the exemption amount was $215,000. The following year was lowered down to $85,000. So here's what happened is you got into the top paying bracket a lot faster and a lot sooner, okay, because of where you were. Then go to the next page. By 1988, when we're in the 28% tax bracket, the exemption, the top bracket started at $29,000. So there's been in New Jersey a few years ago, we had our bracket move, our tax bracket move. So let's just assume for a second that I was making $100,000 a year. And our income tax bracket was something like 4%, and then they moved it to 6% at the time, but they took away the ability to deduct our property taxes. So if I was making $100,000 and had $10,000 a year in property taxes, I was only paying tax on $90,000, right, on the state level. But what they did is they raised the rate and they raised the threshold amount of what was going to be taxed, so more of my money was being taxed. So it was really a much greater increase in the rate. So what we are now seeing is this thing is slow, the income exemption has slowly gone up, the tax bracket is back up to a 39.6% bracket, and what we now have is we have a lot more payroll taxes, the Medicare tax, okay? So when you're building a wealth plan, when you're building a strategy, the deferral might seem like a really good thing, but it's really dependent upon what you have already accumulated in your wealth. Do you have a lot of times I meet clients and 90% of what they have is in tax deferred assets. And I don't know, I don't have a crystal ball. I told people a long time ago that my grandmother bought me a crystal ball when I first came into the industry. And day one on the job, I turned around and I knocked it off and it shattered into a million pieces, okay? So I don't have my crystal ball anymore. You only get one option with that, okay? So I don't know where we're here. If I was taking a trend, the trend looks like it's coming back up, but who knows, okay? Who knows what future tax law is going to be? So the concept is, if all my eggs are in one basket, I'm not balanced enough to be reactive. So if this was me here deferring and I end up somewhere up in this category, somewhere up here in the future, or even if I end up in the same tax bracket, okay, did I really gain anything? So we really have to be aware of your present position, your present wealth plan, and understand how is it being taxed, where are you being taxed, can we defer a portion of your money, does deferral make sense, does paying taxes now, one of the greatest things that we have in our current tax law is we have a separate tax bracket. Ordinary income, taxed at 39.6 at the top bracket plus Medicare. Capital gains and qualified dividends are being taxed at 20% plus Medicare plus tax. So you have this divergence in tax, okay? So strategy becomes the important thing. I see a lot of people, don't buy this product because of the tax deferral, not the tax deferral. You don't want to pay taxes, you want to defer the taxes, but defer to what, and what's our strategy for getting it out? Okay, and that's what you really have to focus on from a standpoint of, is that if all my money's in deferred assets and I end up in the same bracket or a higher bracket, if I end up a higher bracket, that was a losing strategy. If I end up in a lower bracket, it was a winning strategy. But I don't think you and I are in control of what the brackets are going to be in the future and how much income it's going to be. There's this perception that when I retire, I'm going to be in a lower tax bracket. Most of the people that we work with, most of the clients, they don't end up in a lower tax bracket. The house is paid for, the kids are out of the house, they lose a lot of their deductions, so they actually end up in a higher tax bracket. Because you got to think about right now, where are you now? What is your effective bracket and what is your marginal bracket? So this is for the year 2013. And this is that last dollar being taxed. So here at $450,000 worth of income, we hit the 39.6% bracket. This is the tax rate. This is the amount of income that's being earned. Okay? If I'm here, my effective bracket may only be 12 or 13%. And if I'm deferring into my 401k plan at this high, my low tax bracket, and I'm successful and I accumulate money because that's what I want to do, correct? And I defer and defer and defer and defer. I was deferring at 12. In the future, I come back. I'm down in this zone. The blue level, the current bracket is here. I go into the future. I defer a lot of money. I'm probably going to be in a higher tax bracket. I don't really know that, okay? But that's probably what's going to happen. And then in here, so what you're seeing is that your effective bracket, as at $1 million worth of earnings, your effective bracket is about 35% plus Medicaid, okay, Medicare, excuse me, okay, coming out here. And that eventually, if we kept running this thing out, that as your income became greater and greater, if you're a $2 million, $3 million, $4 million, $20 million a year person, you're getting really close to that, because one of the things that's also happening is your itemized deductions are getting phased out, et cetera, okay? So knowing where you are, knowing what your bracket is, you have multiple options to put in your plan. There's Roth IRAs, 401 Roths as opposed to 401ks. I would say a great majority of people come in, they work for an employer, they don't know that the 401 Roth option exists. There's multiple financial products out there that you can coordinate and look at together in a coordinated methodology that are going to help mitigate the current taxation. I'm a firm believer in, if I can lower my taxes today through strategy and not end up with, deferral is a role in the plan, but not paying taxes today and accumulate money on a taxable, tax-free basis is a really important part of a plan, but it has to be balanced, okay? So what we're looking at here is that the key points that I wanted you to learn is that the tax brackets are at some of the most historical low points that when we look back at history, this marginal bracket is at a very low spot. It is painful, trust me, I know, okay? It is a painful tax bracket, especially with the Medicare. That balancing your plan is much more important. You know, it's not black and it's not white, meaning deferral is good, deferral is bad. It's not good or bad because the crystal ball doesn't know the outcome. Okay, I don't know where we're going to be 15 years from now. I don't know where my personal circumstances are. Am I going to be, unhealthy and be able to take money out and benefit from medical deductions? That's not a good thing, but it could happen. Okay, so I want you to know where you are in your bracket. I want you to know that the history. You need to understand the balance of where your assets are, and you have to understand based on that. This is something that I cannot rely on. Right? I cannot rely on that things will be constant because what this tells me is nothing is constant, okay? And I have to know where my effective bracket is versus my marginal bracket. So when a client comes to us and looks at the plan is everybody wants to reduce their taxes. And there's tools out there that you own currently today that you can benefit by reducing your taxes. And you need to understand the power of those deductions that you can get in your strategy and understand what those options are before we simply just take a very quick thing and defer. What if there's a better way to get it done? What if there was a more appropriate way for my financial strategy? So that's what I really want you to understand is that tax rates are changing. Historically, we're at low tax brackets. Your plan is unique to you. Your circumstances are unique to you. And what's right for you is not necessarily right for your neighbor, okay? And vice versa. So you have to really look at your current plan. We have a team of advisors that we're here to help you. We're here to help you assess what's going on. We have a wealth curve pressure identifier, which is a very quick, handy form that you can download. You can form fill it online in a PDF. It'll do a lot of calculations for you. Or you can print it out old-fashioned, sit down with a magazine and just write on it and sit in front of the fire and get clear on what's going on in my life. Where's my income? How much taxes am I currently paying? Where am I saving money? What's my lifestyle? What's my debt structure like? Understand where that is, and we would love to have a conversation with that form with you so we can really assess how we might be able to help you in your future. Thank you, and I wish you the best of luck.